Good evening. I'm Ashley Murphy, CFP AIF, the founder and principal of Arete Wealth Strategists. I'm very pleased to welcome to tonight's webinar David Runkle from AFEX. AFEX is a specialist currency exchange operator that we use. Without further ado, let's get into it. The importance of doing foreign exchange right. So let me quickly go through the disclosures, of course. This doesn't constitute financial advice or recommendations. I would recommend that you speak with a commodities trader, a licensed commodities trader, if that is the specific kind of advice that you're seeking on foreign exchange. A little bit about me. I'm a tri-citizen, moved to the US in 2005, worked in corporate finance. I've been a financial advisor now for, well, you could say for the past decade. Launched Arete Wealth Strategists back in 2013, and Arete Wealth Strategists Australia the next year in 2014. So we work with Aussie expats in the US and Americans in Australia who qualify as per the ASIC regulation for a wholesale investor, which is a minimum investable assets of $500,000. I've been a regular conference speaker in the US to Australian audiences, and am presently a member of the International and Cross-Border Knowledge Circle with the Financial Planning Association. All right, my company, Arete Wealth Strategists, is really split into two groups. You could say it's Arete Wealth Strategists Australia and Arete Wealth Strategists. So the domestic brand is really focused on US business owners and executives, and as you heard me say before, we work with Aussie expats and Americans in Australia. So tonight, what are we talking about? It's going to be a brief background as to the inspiration to this topic. Why am I bothering to talk about foreign exchange at all? It seems like a very dry, dull, commodity-like function that needs to happen for folks moving across borders. I'll tell you a story of why that matters. How foreign exchange works, the importance of the spread, and you'll come to understand the spread in just a moment, what is meant by the strength of a currency, drivers of the specific relationship between the US dollar and the Australian dollar, the effect the Australian election, the recent Australian election had on that currency movement, and strategies for major money movements. So first of all, I want to tell you just a brief story about a client interaction I had recently. This wasn't the first such interaction. This has happened many times over the years, but it was really one that was that's fresh in my mind as I was preparing for this webinar. And it was a high net worth client seeking to move, coincidentally, to Australia. Would you believe? So I think very often clients have a bias, a very natural and understandable bias, to want to keep their money earning the highest rate of interest in a savings account that they can. I mean, that's the existence, why the carry trade exists in the first place, is people want to invest their money where they can earn a higher guaranteed rate of return. The thing is, it's not a guaranteed rate of return at all. You would think that earning 2.2% in high yield savings accounts, you know, with FDIC insurance, is about as guaranteed as it gets. That's true when you're only concerned with the US dollar. But what if your terminal currency, what you really want at the end of your well-considered foreign exchange conversion plan, is a different currency? Then all of a sudden that fixed exchange rate doesn't seem nearly as important or relevant anymore. So this is what leads to making decisions based on the savings rate without implications or without considering the implications of the foreign exchange movement. So for instance, this was a situation I dealt with 3 weeks ago with the client that I just alluded to. So he's talking about moving his entire net worth from the US to Australia, and thought, well, gosh, you know, I better leave this particular $1 million, leave it in the US, earning the highest amount that it can earn, because I don't want to move it to Australia, where what are they paying in a savings account? They're paying nothing. So that doesn't make any sense. Well, that might be true if it weren't for taking some stock of where we are historically with this particular currency. And you can see at least for the last couple of years, we are very nearly at I would say an historic low. That was a low, I believe it was 2001. We hit 48 cents, so not quite there. But when you begin to consider a minor movement in the exchange rate could have a significant impact on the terminal converted value of that client's US dollars once they become Australian dollars. And I created this little graph here to illustrate the point. So we're currently at 69.5. Well, what if it went to 75, 70, 72.5? You would see the difference there. It's measured really in $20,000 increments. So in other words, what is granted a fairly large intraday movement, but not unheard of by any means. If we had a fairly large intraday movement of that, you've just wiped out a full 12 months of savings in a savings account. Now, that's not to say we shouldn't be trying to earn the highest rate of savings on cash that's sitting there. That's not my point. My point is to drive home the importance of foreign exchange done right. Okay, so how does foreign exchange trading actually work? An exchange rate is represented in a foreign currency that represents how much you might get if you had, let's say, US dollars going to Australia. Your US dollars are going to become a multiple of that in Australian dollars. So really, we think of, and this is a very important point, we think of there being two foreign exchange markets. There's really the retail or cash market, and you could think of that's what you're using if you're on holidays. Are you going to bother setting up special accounts, getting special cards, going through all the headache so that you can save what would be a small amount of money relative to moving your entire life savings if you're taking a trip to Europe for a week or something small, compared with, say, the wholesale market, which is quite a different market altogether, more for individuals moving their life savings or for businesses. And that's where firms like AFEX come into it, where they are working with much larger currency transfers. Granted, they're also in the retail space and have a presence that I happened by random chance to bump into in New York when I was there 2 months ago. Another key concept we need to define here, interbank rate. What is the interbank rate? That's the rate at which banks themselves will deal in foreign exchange. So it's basically very similar to how banks make money off of home loans. They're borrowing from the Federal Reserve. They have their markup, and what they're lending to you is their profit margin, essentially. The spread equals their profit margin. So that kind of answers the second point here on the spread. How do they make money? They make money on charging a spread on the interbank rate. Simple as that. In the retail market, there is still the scourge of the commission. So if you happen to go, heaven forbid, go to one of the airport foreign exchange providers and deal with them, give them your hard-earned cash, they're going to take typically a 2 or 3, possibly more. David, have you seen more than that? You might have more familiarity with that.
Yeah, so from what I've heard is airports are usually around a 10% spread on their exchange rate. It can be one of the worst areas to be exchanging, losing hundreds of dollars. They could be spent on a nice bottle of wine or a dinner out with your family.
Absolutely. Now that isn't by any means, and we'll see on the next slide when we talk about the importance of the spread, that isn't by any means to say that your ATM card is the be all and end all. It's not. It's just not as bad as those as the rates that you typically see at one of the counters in an airport. So what is this that I've got up here? Actually, I've already got it open over here. So let's look at this one. Okay, this is a spreadsheet I've created to convert to show the difference in the spread between a number of different providers. David, you've just inspired me to add a bottom line here. I won't do it right now, but we'll say typical airport conversion rate. Well, I guess I will do it right now. So it would be 1. So it'd be just a shocking difference. So anyway, what we have here is, this is the Australian US dollar exchange rate right now. This is the interbank rate with no spread. You can't get the interbank rate, so It's really just here for illustrative purposes. Interactive brokers. This is one of the currency conversion solutions that we recommend. They do charge a minimum of a $2 commission. You just heard me speak badly about commissions, but when the choice is paying $2 to get the absolute best spread imaginable, yes, that is 0.0002%. That's correct. You would see your $1 million Australian would actually become $692,571 US dollars, with a difference of $139 over the interbank rate. And you can see the various differences here. Here's AFEX's typical spread, that's 20 basis points or 0.2%. It's going to cost a little bit of money, but I think that's good value when you consider the service and the time saved in dealing with such a provider. And you'll hear me talk more about that. TransferWise, these guys have made a big splash in the last couple of years. And I would say they make a lot of sense, but for far fewer client situations than what most people might typically perceive. And the reason I say that is I think TransferWise are a great option right here. Whoop, excuse me. We're moving in and out of presentation mode. I think they're a great option when you're talking about the retail cash market. A 60 basis point or 0.6% spread compared with 2% or more, that's fantastic. But you need to ask yourself, does TransferWise even exist in the markets that you're going to with their handy dandy debit card? And I can tell you that I've been on the waiting list for that for about 18 months and I've yet to receive my card. So it's a nice thought in theory. Let's go back to that spreadsheet. Okay, typical ATM rates, that's what you're losing. But keep in mind, if just what I was saying before, if you're spending $2,000 or let's say $4,000 on a trip, all of a sudden, the difference between, say, the most efficient way that you might do it, namely with interactive brokers, $55, I'd rather $55 in my client's pocket than in the bank's pocket, but there could be a heck of a lot of inconvenience and time involved in setting that up, which would make it less than ideal. That was the point of showing you this spreadsheet here on various spreads. Okay, next slide. What is meant by the strength of a currency? You'll hear economic commentators in the media talk about the US dollar is strong. Well, what does that mean? It really doesn't actually have a great deal of meaning to any individual. And here's why. Because the value of a currency, the strength of a currency is really with reference to a whole basket. When we're talking about going somewhere, moving across borders, we're talking about going from country A to country B. We don't care about a whole basket. We care about a pairwise relationship, a particular currency. And so it's for that reason that we don't so much care about the strength of a currency at large. We care about the strength of that pairwise relationship only. So what makes a currency strong? A demand for a currency is driven by a number of factors. David, this might be your talking points right here in the next couple of slides. So I'll pass over to David Runkle from AFEX.
Hey there, yep. So there's many things that can be affecting a currency exchange rate. A lot of times you'll think about trade, people buying goods from different countries back and forth. But one of the biggest drivers for the exchange rates is actually the interest rates. So depending on the interest rate of a different economy, there'll be a higher demand for that currency between the two. As you were mentioning with the relative strength, you want to think about the relative interest rates. So currently the Australian interest rate is lower than the US interest rate. So that means there's going to be a lot less demand for the Australian currency versus the US dollar currency. So that's why we've actually seen such a huge decline over the few years in the Australian US dollar exchange rate, is because as the Australian economy has slowed and there's been a housing bubble that's been going down, there's been a lot of monetary policy easing, lowering the exchange rate, or excuse me, the interest rate in order to stimulate the economy. But this has had quite a negative effect on the exchange rate itself, which can actually play into the monetary policy because that makes the exports more attractive from that economy. And it's all driven by that search for yield. The carry trade, as you mentioned earlier, a lot of people don't really understand that. So it's mostly big money investment managers that are controlling the flow of funds between the exchange rate and ultimately driving the exchange rate lower. And so if we want to talk a little bit about the U.S.-China trade war, that actually plays right along with it. So with the developments of that, there's a lot of concern that there's going to be less demand coming from China on the Australian market, which would mean a weaker Australian economy, which would mean more monetary easing, continued suppressed interest rates. But if there's any positive developments coming out, we could see a reversal potentially, because right now the central bank and the market participants are so dovish, expecting further interest rate cuts and a slower economy. If we start to see some positive news, then there could be a return to Australian dollar strength. This slide I really like here. This is a very interesting illustration of an event causing such a large movement in the exchange rate of a currency. The election of a presidential candidate that's expected to cut taxes would mean that it would increase the economic activity of that country, which would then hopefully allow the central bank in Australia to begin raising their interest rate again. And so that speculation that there could be this return to Australian dollar strength has caused a lot of speculators to jump on board after that announcement and create that big pop in the Australian dollars you can see there on that chart.
Okay, well, I'll just bring it back to these points on a well-considered foreign exchange strategy. Thank you, David, for your comments, by the way.
You're welcome.
I wanted to outline how I would recommend, if one were thinking about how you go about formulating a well-considered foreign exchange strategy, it would look something like this. First of all, understanding, getting a feel for that particular pairwise relationship, knowing how things look. As you saw earlier in tonight's presentation, I was looking at the US-Australian exchange rate over the last couple of years, and we saw that it's at pretty much a recent historic low. Having some idea of your departure date, knowing when you're going to be leaving, to have knowledge of when you might want to have funds available in that foreign currency. And then, of course, the time frame over which you will begin to need funds. I can give an example of a client just from earlier today where she's talking about moving back to Australia and purchasing an apartment in Melbourne in 2 years' time. Well, it would be very helpful if she had all of the money that she needed to purchase that apartment available, obviously, within 2 years' time. So it's that particular information that would set up how long it is that a transfer strategy might operate for. Next would be forming a view between those currencies and saying, you know what, I think interest rates in Australia are going to stay down, things in the US are going to continue to improve. What effect would that have on exchange rates going forward? I think there's a global decarbonization of the electrical supply chain or electricity generation supply chain. Maybe that'll put a damper on coal. What will that do for Australia? And so on and so forth. You begin to think about what the main drivers are and what the direction is you see for that currency over time. Then you think about establishing a periodic transfer. What's the reason for this? The reason would be you're hoping, without the use of any other hedging instruments, to obtain the average exchange rate or the best exchange rate you can over that period of time. And one tool or one strategy we recommend for accomplishing that might be dollar cost averaging. So excuse me, doing a conversion, say every month or every quarter for that period of time, so that you get the average rate of that period of time, or at least you set up a schedule so that you will convert in a disciplined and systematic way and not just at a knee-jerk reaction. Choose the venue. This goes back to the choice of working with, say, someone like Interactive Brokers or AFEX. It's actually something that really needs to be thought about. To establish an account with Interactive Brokers takes time. It's not easy to use. It could be a real pain, and they've got monthly account keeping fees for balances less than $100,000. So we need to consider, do you have the inclination to do that? We work with clients to handhold them through that process and make it as easy as possible. Or alternatively, would it make sense to work with someone like David and AFEX to use their services? Risk management, of course, this comes back to a whole nother topic that's a little too advanced for tonight's purposes, but the idea here would be to use such hedging instruments as forwards or option strategies. David, maybe you'd like to take just a moment to talk with us about what we won't talk about option strategies with you, but if you could just define for us, what is a forward contract and how might someone listening to this presentation go about obtaining one of those contracts?
Yeah, I'd love to speak about that. I think so far you really hit the nail on the head with exactly what someone needs to be considering with their foreign exchange strategy. And forwards are really a big part of that because most of us, we're not in the FX market to try to speculate and make a profit on it. We work in our own respective industries. And so you really want to take the risk off the table when you're thinking about the FX market, because to be honest, even the professionals and the forecasters, they don't get it right, not all the time. So it's best to not gamble when you're thinking about FX. You want to lock in a forward contract, which leaves you a budgeted rate. You know exactly what to expect over the course of a year. A good example for this a lot of times is someone that's purchasing a home in a different country. They want to make sure that over the few months that they're going through escrow or when they're looking for the home, that the exchange rate isn't going to move against them. So they're going to use a forward contract. So what this allows you to do is lock in the exchange rate at what it is today, and then you don't have to put up any money for it yet until you're ready to actually send the funds. So say, for example, you want to do a 6-month forward contract. Now you're locked in for the next 6 months. You know exactly what to expect. The market cannot move against you at this point. And a lot of times you can even get a better exchange rate with this if the interest rate of the country that you're going to is higher. Unfortunately, right now, the Australian interest rate is much lower than the US dollar, so the forward points kind of go against you a little bit as you push it out. But it's definitely kind of worth it. It's almost like a loan in a way, if you think about it that way. And most of the time, people see those few points against them as a good, that's not a big problem to keep them from doing the forward contract.
Thank you for that, David. And just another strategy I wanted to hint at and briefly explain here. You can see I've got it in text here in a comment by the side, to do with an option strategy. This is what's referred to as a forward extras type strategy. So you see in this scenario, we're talking about converting $1 million Australian dollars, and we've got a strike price of 69 cents and what's called a barrier of 64. I'm going to try and turn this into fewer. Your US dollars are obtaining fewer Australian dollars when you purchase it. So if it's staying below that level, you're guaranteed to get at least that price. Thus, it gives you 100% protection from a negative movement at that level. Between these two levels, say 69.25 and 64.95, would be your profit. Your maximum profit scenario would be 64.96, as you see down here, where if the exchange rate were to lower beneath that level, then in fact you'd end up owing the 69.25 as payment for the risk that you've taken on there. So, but in any event, it gives people a corridor. This I've described. The difference between these two exchange rates right here, you could describe as a corridor of profit with a capped downside. So that is just an example of what I was referring to with regards to an active hedging strategy. All right. So Arete downloads, we've got an Australian Financial Services Royal Commission that's finished up. They finished up back in the beginning of February. What might it signal for the US? This is really more of a professional publication for other advisors. Safe as houses, that's something that might actually already be up on my website. I think it is. It went up. It should have gone up last night. You can find our key financial data sheets, the only provider that I'm aware of where we actually have both US and Australian information on the one key financial data sheet. Where do I learn more? Please go to our website, arete-wa.com, to find these recorded webinars, and also to complete our contact form and schedule an appointment. Thank you very much, David Runkle from AFEX, for joining me here tonight, and thank you for watching our presentation here.